Good afternoon, everybody. Welcome to Trader Merlin Show. It is I don't even know what day it is anymore. It's Wednesday afternoon. I know that my audio is working fine. Actually, it's a little bit hot, so I'm going to tune this down just a hair here. Still haven't figured out what the issue was from yesterday's show with Bill Addis, so I apologize for those who were glued to that show, and all of a sudden, boom, we had an abrupt about face with our content. But hopefully today goes smoother. I have no guess, which should make it much, much better. I'm also going to apologize. This is going to be a short show today. My voice is just tapped out. I was teaching a crypto class from 7 a.m. this morning till 1:30, and now I'm pretty gassed. Plus, I got to teach another class tonight. So my voice is going to be shot, crackled. I'm tired. I'm cranky, and markets were fun today. I didn't get to touch them at all. So let's dive into that. Here is the topic du jour. I said markets, more pain ahead. I love the AI-generated pictures. They're phenomenal. My favorite's the older guy on the right-hand side with looking off like just in straight terror. You know, the way that things started off today, as Rajesh says here, Credit Suisse issue is way bigger than Silicon Valley Bank. Agreed. And that's kind of why I put this more pain ahead for our market. So what I'm going to do is I'll just, let me start with the top 7. We'll run through the top 7 markets, and then we'll dive back into the financial sector, which is going to be the catalyst for more downside move. Plus, we'll talk about the shift that happened in the Fed funds futures. All of a sudden, there's a higher probability now of no rate increase whatsoever at the next meeting. I'm still sticking to 25 basis points next week, but that could change. And as Bill mentioned yesterday, these wild swings have been just incredible with regards to bond yields. Today, you saw the 10-year just, again, selling off dramatically, at least from where it closed off the session before. So let me dive into markets overall, and then we'll start from the bottom, work our way to the top, and then get to some financials. Yeah, John says, what a mess. Yeah, it is a mess. I mean, it kind of just reeks of opportunity. You know, we can look at it and say how bad it is and how detrimental it might be to our markets and our economy. I want everyone to not freak out about that and just think opportunity, right? Opportunity is really what is the key thing here. So let me start with crude oil. So crude oil a couple of days ago was sitting in the middle of the range of this yellow box, and we finally broke it to the downside. Now, the question now becomes, so where's this thing going to head? If you look at the lower points here from some of these tails that go back into 2021, you know, that would be the most logical spot. Now, I don't remember why exactly we drew the $60.63 mark on the crude oil chart, but you know, you could argue that is this nice kind of resting point where we pulled back and did a retest back in April of 2021. But I do think these tails right in here, maybe slightly before, I'm thinking more along the lines of $62 will be that next stopping point for crude oil, which is about a 9% slide from current level. So crude oil not looking good right now. Much more pain potentially ahead here based off this break. Now, the good news for anybody who thinks there might be a pause on this sell-off on crude oil is the way that we rebounded, right? So there was a much bigger sell-off during the day. Let me get my percentages correct here. From the close of yesterday, at one point in today's trading, crude oil was down 7.96%, so almost 8% slide, yet at the end of the day, finishing down just 4.33. So all in all, nowhere near as bad as it was at the middle of the day, recouping some of those losses. So we'll see if there's momentum and follow through here back up, but still not good that you broke down below those lows right around $70.40. But you know, it is what it is. We talked about those levels for a reason, draw those boxes for a reason. So if you were long, should have been stopped out of crude oil at this point. Bitcoin, crypto, gave back a bit of its gains over the past week, which have been phenomenal, down 2.89%. It's not helping gas prices in California. No, it's not at all. Anybody want to buy an electric bike? Yeah, I'm loving my Schwab too, Big Ab. It's funny because, you know, if you read the article I wrote for barchart.com, you know, it might be a good thing that there's no comments on there because I'm sure people light me up. Oh, you're getting screwed on your Bank of America and your JP Morgan. Yeah, but I'm doing great. And actually, the biggest position I wrote on the options was on Charles Schwab, which has been great. Although, you know, you really got to look at the end of day on Friday for those specific trades. You know, we could see all kinds of crazy volatility. My gut tells me we're going to see more pain to the south side here, but all in all, the PPI number that came out today was great. Let's not talk economic data. Hey, good doc, good to see you. I am a busy man. I'm pretty damn tired. So let's keep working our way up the list. Bitcoin was at 24,495. Most of the crypto world taking a little bit of a pullback today, which is expected after such a colossal run. The potential for a bank bailout and knowing that there's more capital out there to throw around into the crypto world, I think is what kind of had crypto popping over the past few days, and a retracement should be normal. All right, let's move on up the list. Dow was only down 0.98%, rounded up to 1. Again, it broke down below the lower end of that yellow box, seeked out a new low, and I'll have to reestablish. I guess I should get rid of these yellow boxes that have been violated, because it might distract our eyes and deter us from what's really happening. But right now, that Dow continuing to show weakness, even though yesterday was a great bullish day. We talked about the trend, at least for the past few months, has been showing slowing weakness. It finally broke the lower end of that yellow box and now potentially seeking out some new lows. I think about 30,450 would probably be the next logical target for the Dow. Russell 2000, fourth place. Similar picture, although we talked about it bottoming out potentially at this lows from December 29th. We tailed into that a couple days ago, bounced off it, hit it again today. So the more times we tap this lower level, right around 1733, becomes a damage point for the Russell. Although, Tom, you sent an email saying that the yellow box is dead for the Russell. I don't think so. I think it's still intact. Right? And it's because you got these highs and lows established. You could actually, if you wanted to be more aggressive, just tighten that yellow box up to the lows that we just talked about, right? I personally like to go the whole range, so I would have it where it was there. Bottom line, still traversing sideways, even though it's had huge pain point for the past 5 trading sessions, down another 1% today to 1762. Technically, though, looks poised for a bounce because you're right near that demand level. All right, finally, podium time. Here's your S&P 500. Down 0.73% today to 3,925. From a technical perspective, I don't really see anything having changed here. The good news is we still are, I know, technically making higher lows. You can see the low started back on October 13th. We came back, tried to make a new low on November, didn't do it. Tried to make a new low on December 28th, didn't make a new low. It's slowly trudging higher. The key, and what's important for the S&P is what happens from here, right? Do we end up breaking the 4,100 mark and then challenging 42 again and showing this uptrend since October is intact? Or does it start to roll over, challenge those lows from back in December, and ultimately chase back down to those lows right around 3,600? And I personally think that's where we're headed. I think that we're headed back down towards that 3,600 mark, even though the inflation numbers look good, the Fed might backpedal. I think that the fallout from this financial thing could be lingering for some time. It's not just U.S. banks. It's not just regional banks. If you look at the discussion we had over the past week, which is on multiple occasions, has been about reserve requirements at zero, banks buying assets that they maybe should not have been buying, albeit treasuries, which are safe, still losing out if there's kind of a run on the bank. So to me, that looks like the problem here. And if Credit Suisse screwed, I see John just says, can it be said that all of the nonsense today was due to the Credit Suisse screw up? Yep, absolutely. And I wouldn't say all of it, right? You can never say everything that happened today, but you look at the bailouts that aren't bailouts here in the U.S., right? Remember, they're not bailouts, not bailouts, but the bailouts that happen here in the U.S. of Silicon Valley Bank and Signature, those were needed to give faith to investors that our markets are going to be fine. Credit Suisse is a different ballgame. That's not us. That's global markets. That's international, right? Obviously, we have the stock traded on the NYSE, which we can look at here in just a second. But the systemic risk that poses for Europe opens up a whole nother potential can of worms. And from what I'm reading, they're like, I've been kind of following the Credit Suisse thing for a little bit, and they're saying it's not systemic. It's not going to impact the other banks. I say hogwash. When you have the Bank of Saudi Arabia basically say, we're not going to give you any more money, pretty sure that's them going, stop loss. And Credit Suisse might find themselves with more pain ahead. Now, I'll show you a chart of Credit Suisse in just a minute. I want to make sure I get through our top 7, and then I can deviate from the path. So your S&P was your third place, down 0.74%. You keep going here, and there's your NASDAQ, which for most of the day was negative, and all of a sudden it's had a great tendency to just start to rip and show nice gains near the end of the day. And NASDAQ looking pretty good, closing up 0.33%, 12,377. Technically, though, I don't see anything here that is noteworthy or something to write home about, right? It's just a nice big bounce off this. Why? Because you don't have a lot of bank stocks in tech. Now, granted, so you don't have a lot of bank stocks in the NASDAQ. They're going to be predominantly NASDAQ. There are some, that's for sure. But Silicon Valley Bank and Signature. But I think more impact is the positive aspects for tech pulling this one up. So this is the outlier for sure. You had the S&P, you had the Russell, you had the Dow all negative today, and NASDAQ kind of eking its way into positive territory. For today, I'm just going to call that one an outlier. Last one. Gold, 1.07%. I, again, am still going to reiterate, I think 2,000 is your next logical target on this one. Showing just phenomenal move up. Bummer that I have more silver than I do gold, but I do like the gold chart here. Moving to the upside. Now that I got that done, I'll bring up silver since I saw a couple of you ask about this one. There was actually a comment that came in. Where was that one? Oh, damn, now where did I put it? Right. There was one question that said, do you think silver is going to be going down before it goes up? Where was that? Oh, well, I guess oh, there we go. From Rob, who might be with us today. Rob says, SLV, is it going down before going up further? Well, look, I have no idea. I don't know which way it's going to go. What I'm looking at here is you have this pretty pronounced downtrend that started back in January, right? It's a really aggressive sell-off. All of a sudden now we gap up and start to run. Does this rally back up to the red line we have here, which is right around 2050? Right, that was where I was selling some puts before. I don't know. Given the way that the market transpired today, it was completely the opposite of what gold did. Gold kind of showed strength all day, whereas silver showed weakness all day. And even though it was up 0.55% on the session, the last 2 days have had a gap up and a sell-off, gap up and a sell-off. So to me, it doesn't look great from a technical perspective. I still am long silver, so I'm fine with that. I need to check my account. I tried to sell some $21 call options against my position, which would expire not this week, but next week, the 24th. But I haven't had a chance to log into my account because I've been busy and teaching all day. So I don't know if those trades have actually gone through, but I am long SLV at this moment, and I am intermediate term bullish, Rob, but I just don't. It's going to go down before going up. Looking at this chart, it does look like it wants to go down. It just feels like every day it just gets beaten down. Starts off strong and ends weak, whereas GLD, right, you got a similar picture that it gaps up, but it's just showing a bit more strength here. The good news is the gap ups are happening, and it's looking more positive for the long term. So there we go. Chase says, Big Tab reaping the benefits of the drop in yields, bullish cross, no competition from Silicon Valley Bank startups. How long can it last? Well, look, I think what you have is a rotation of market sentiment. So right now, obviously, the segment that's taking the drubbing is going to be financials, right? That's got everybody freaked out. I'll show you my list here. This is the list of the 11 market segment ETFs for the S&P. Even though financials were down 2.67% today, energy still beat it. Energy was down 5.37% for XLE. You have some positive ones. They say in a recessionary environment, when that market's rolling over, utilities are a good bet. XLU was the best performer today at 1.36%. And technology was positive as well, which is probably what bolstered that NASDAQ move to the upside. So a lot of pain out there still. Now, with regards to the banking sector, here's Credit Suisse, which, no, I'm not interested in buying Credit Suisse. Someone asked me that. I'm like, no, I'm not interested. I don't think so. I have to just let it run its course. If you look at this price chart right here, let me put it on a weekly so it doesn't squish the candles as much. But here is, this is Credit Suisse going back into 2010. So, to expect that Credit Suisse is going to break this trend, which has literally been nothing but pain for the past 13 years, I just don't see it. I hate to say it, but what looks like could happen here is this just go to zero. And that would be a monster blow. This is such a big name around the world, Credit Suisse Group. But just looking at that price chart, I mean, it just looks like it's just bleeding to death and headed towards zero. Now, I haven't looked at some of the fundamental stats on this one to see what the short interest is and float and all that stuff, but that picture just screams that it's getting worse and worse and worse, and there might become a point here where they just say enough is enough, we're insolvent, and that could obviously create some huge moves for the market, and I do believe that today's action, which has Credit Suisse down almost 14%, is a large reason why we saw financials get smoked again today. Here is Let me scroll down here to the XLF components, just since we have that hot on our screen. Forget about Silicon Valley Bank and Signature Bank. They're done. You had FRC today. So First Republic frozen as well. Oh, actually, not frozen. Let's go back to the daily. There you go. They're not frozen, but they were getting a lifeline from JP Morgan, and JP Morgan's helping them out. But you have a lot of big negative positions here. 6%, 6%. AIG down 6%. USB down 5%. Were there any positive ones? Well, there's always something positive, and that just happens to be one that I sold some puts on, which happy about that because those puts are, I was going to close them out early, but there's really no point. I have the $50 puts on Schwab. Really pretty sure that's not going to hit. But here's your Charles Schwab, and I think I saw a question come through there from, let's see if I can get the, Les, that was you. Can you look at Schwab and give your opinion? Look, if you read the article that I wrote for barchart.com, I said, I quoted that Baron Rothschild quote, which was, when there's blood in the streets, you want to be buying, even if it's your own blood. And I looked in the financial markets, and man, there's blood all over the place. It's a bloodbath, and some of these companies don't deserve to be there. I went with JP Morgan and Bank of America because those, to me, are two of the biggest bellwethers in the retail financial world, and very, very diversified. The Charles Schwab one was, I don't think they deserve to be there. I don't think they deserve to be beaten down. I mean, look at the chart of Charles Schwab. This is insane how much they got beaten down. They haven't seen crashes like this since 87's financial Black Friday meltdown, right? If you go back to Wednesday of last week, from peak to trough, we're down to 40%. If you go to where this sell-off really started, which goes back to February 27th, this thing's down 44%. Charles Schwab, it's not really a bank like traditional banks are. They're more one of the largest brokerage firms. So for me, I was looking at a potential bounce there for Charles Schwab. My mistake that I made with Schwab is I should have bought calls, not sold puts, but I was playing a little bit risk averse and collecting some really nice premium. It was actually like 7%, 6.98%. For 5 days. I sold those puts on Monday. I wish I would have bought the calls, but three words that don't exist in our world, which is should have, could have, and would have. So what do I think about Schwab? Look, it's really hard to base technical analysis opinions on a chart that looks like this. This is very difficult. Supply and demand zones get all thrown out of whack. I personally think that Schwab is going to slowly creep back up. They're not the typical. They're not a bank per se like Silicon Valley Bank or Signature Bank. They're more of a brokerage firm, investment services. So I don't see the pain point there and why Schwab got caught up in all this. And I do think that they'll start to move back up. But as far as levels, I don't know. It's really hard to put levels on this when you have moves of that magnitude. Let's see. Do you think Netflix is due for a bounce? NFLX. I'll go back to financials in a second, but let's check out Netflix. I didn't see, if you look at the chart here that happened with Netflix, I don't really see it having come down to an area of demand that I would have said was worthy of there being a bounce. Overall, this is just a pullback. So this uptrend that started back in May, remember this was long after Jim Cramer said he issued his buy, which was up here at $600. We've closed that gap. There is another gap looming, and brings us all the way up to about 520, but I don't think that's going to happen for quite some time. I think you got a bit too much competition in this space. I think that the raising of rates and charging people for ads, etc., I think is not maybe the best idea for Netflix, but what the hell do I know? I don't run my own company, so there you go. Yep, that's right. Talking Monkey says Charles Schwab acquired TD Ameritrade. Yep, TD Ameritrade, and I think JP Morgan bought E-Trade, if I'm not mistaken. So, some of these retail firms, they're going after retail customers, which is why I like JP Morgan and Charles Schwab. So, I don't know. This is kind of a tough one here when I look at this Netflix chart. You had a nice pop up there today, which great. It was warranted. It's been a hell of a sell-off. If I look at this, my short-term trader tells me that we're in a downtrend starting from February, so I'm looking for pullbacks to go short, which would mean I'm looking to short right around 311. But I'll be honest, I don't feel comfortable making a trade on Netflix. It's just nothing there screams at me that I need to be going short or going long. So I personally would just walk away from this one until I see something more convincing. I'm not going to try to force a trade to come to fruition. All right. Hi, Merlin. When will we see you in Chat with Traders? What's Chat with Traders, JB? Let's see what else. I'm scrolling back here, looking through some of the comments. Rob, I did yours little silver one there. Let's go. I see Memphis. One night of Memphis. I like that. What else do I got here? Downgrades from banks are happening after the mishap. Rather, it should have happened before the mishap. That's the point of having. Yeah. Well, you're right, Ganesh. But here's the thing: never, ever trust or listen to an upgrade or a downgrade issued by an institution. Never. It's like listening to a drug addict tell you that they're clean. No, they're an addict. These upgrades and downgrades are historically reactionary. So what will happen is because the markets, and you can look at financials as an example, because the financials have been beaten down so much, what will happen is the banks now start to downgrade aggressively. Let's be honest, if this was your job, and your job was to be an analyst covering Silicon Valley Bank, you knew about this. If you're an analyst and your job is to look at this company's financials, their balance sheets, and know exactly where they stand because that's your freaking job, you knew about this. So yes, they could have issued a downgrade before all of this happened, but then that might have created a little bit of a panic. That might have prevented the firm that analyst is working for from building a position to capitalize on that down move. That said, I'm hearing some rumors that there was heavy shorting going on Silicon Valley Bank right before it was frozen by feds, which means the person that got to sell it at a high price doesn't have to buy it back. That's a great trade right there. You got all the profit, you don't have to buy it back. So essentially ends up going to zero. So I see quite a bit of problem with downgrades and upgrades. Always think that they're a scam. Always think that you're being played. And I believe that, and I've seen this before, if a company issues an upgrade, all of a sudden, I could see that market maker's name selling on the inside ask all day long. Or let's say Goldman issues a downgrade on something. When I traded level 2, I would look at level 2 and see Goldman Sachs buying all day long. You're like, wait a second. You just told everybody in the world to sell this thing. You downgraded it, and you're the one buying. You're probably being played, right? The financial markets are a poker table, and that's one of their tells. Watch out for upgrades and downgrades. Do not trust it. Absolutely not. Oh, scammers. Tom says, I had a shorter time frame on my yellow box. Okay. It's like the one you showed, so I am looking at working with those lower levels. Perfect. Excellent. Let's see. John, well, like a good trader in trading, I had all my levels picked out and ready to go this morning. It all went to trash. It is what it is, man. It is what it is. No worries. The best part is you got more levels tomorrow. Or look at the bigger time frames and look for those deeper levels. Simple. Easy. Don't worry about it. If the banks need to liquidate metals... What if banks need to liquidate metals to pay depositors? Well, most regional and large banks aren't holding gold. That's more of a central bank thing, if that's what you're referencing. They may need to sell off some assets. Now, the key here is looking at which banks have biggest exposure. Silicon Valley Bank was one of the biggest ones out there with regards to uninsured accounts. It was like 90% of their accounts were uninsured, meaning over $250,000. So I'm not so worried about that. I think there's another question that came through here. Let me see if I can get to all these questions. This one from Michael. He says, why did everyone decide to take their money out? Because they panic. Because the media makes you believe like all of your money is gone. Oh my God, you better get your money now or you're going to lose it all. Run to the bank immediately and pull your money out. No, you have $250,000 worth of protection. Now, if you had $1 million sitting out there, you should have moved it, right? And that's what happened. The same thing happened with Wachovia and with Washington Mutual in 2008. Back then, the limit, I think, was $100,000 or $150,000 limit of FDIC protection. So what happened was people were okay leaving under $100,000 in there, but anything above that, they had to pull out. So if you had $500,000 sitting at any bank right now, in any bank, shame on you. Shame on you. Move it. You take $250,000 and you leave it at your bank. And you take that another $250,000 and you put it in another bank in a different account. Therefore, it's insured, and you insured all $500,000 at two separate banks. So when it does fall or fail, you're covered. Keeping more than $250,000 in one account is simply stupid. Of course, if you're somebody like Circle and you have $3.3 billion sitting in the bank, it's a bit of a problem, right? Where do you put this money? Companies like Circle should not be investing or putting their money in a traditional bank. You should be putting it into a bank that doesn't do fractional reserve banking, right? You should be putting it in something that's safe and stable and not lending it out to earn yield, right? There needs to be a safety mechanism for people who have a lot of money, but you're not earning any yield on it. That's the way it should be. Unfortunately, it's not. Talking Monkey worked at Lehman Brothers for a minute, and they would do a pre-market meeting to, Rico junk they wanted to liquidate. I think I told you guys this story, and this is what made me look at the financial markets in a completely different perspective. And I hate to say it, I hate the financial markets. I think they're one of the most corrupt, deceptive, misleading entities in the world. It's greed on an exponential level. And the story was, I was running a financial management organization, a club in college, right? It was a financial management thing. And basically, we were bringing in all kinds of different guest speakers and, finding out what jobs we could get out of college. What's out there for us? And so we had some CEOs, we had some CFOs, we had some executives for different firms. And this one guy said, hey, my buddy's a broker. He'd love to come in and talk. And we're all like, okay, cool, fine, whatever. And I was already going down that path. I wanted to be a broker. I was working for a financial planning firm, and I found it very interesting. This guy rolls up. He comes into our, it's at lunchtime or something. We got this room reserved. And he comes in there, and he's dressed to the nines. He's got Prada shoes, Armani suit. I mean, hair all slicked back. He is one sharp-looking dude. Throws his keys down on there, and he's got Ferrari keys. And we're all like, okay, this guy's loaded, right? Younger guy. He's probably, at the time, probably was in his 30s. So I'm looking at him like, all right, okay, this looks good. We like this. So he starts talking, and he opens up his presentation, and he goes, guys, look, here's the deal. I make so much money, like I don't even really know what to do with it all. And of course, as a bunch of 20-year-old kids are all like, yeah, this is what I'm talking about, baby. Let's do it. Where's all this money coming from? So he tells us, he goes, look, every morning before markets open, we walk in and we have a traders meeting, and they hand out, sheets of paper. And it will say, and I'm making this up, but the sheet would say, it was a talk track sales pitch for different assets. And the one talk track would be, hi, my name is Merlin Rothfeld of XYZ Brokerage Firm. Listen, I know you got some money with us. It's just kind of sitting idle right now. Our analysts have analyzed Dell computers, and we think Dell is a smoking buy. And he's literally reading a pre-written talk track issued by the firm to get their customers to buy these shares, when in reality, the firm itself was trying to unload or get rid of Dell shares. And they would put in the little margin like a picture of a palm tree. And if it was a palm tree, oh, you sell 10,000 shares of that one? Well, then you got a trip to Hawaii, or different perks if you pump different securities. And I was like, come on, man. Where's this guy's, there's no intelligence there. You're suckering someone into buying something. And there's a great video on YouTube. It's a Saturday Night Live video, which love or hate Saturday Night Live. They've got a couple good skits. And there's this one great skit where it was, I think it was after the financial crisis. Yeah, I think it was financial crisis. They had the CEO of a bank sitting in front of a whole bunch of people, and it's like, let's be honest, or just be honest, or something like that. Straight Talk. It was called Straight Talk. And one of the guys from the audience raises his hand. He goes, well, wait a minute. If in 2001, you guys were buying defensive stocks, why were you telling you were selling the market? Why were you telling everybody like us to buy it? And he goes, well, if you believe like we do that the markets are headed for a big crash, you have to convince somebody to buy it. That's just common sense. That's upgrades and downgrades, and that's what financial firms do all the time. It's straight manipulation, so be careful all the crap that you read. But yeah, that made me lose all my interest in being a broker. I realized there still are some good brokers out there that actually do care. Most are just salespeople. They're really trying to sell product so they can make money for themselves, which, look, we're all working to make money. That's what we're trying to do. However, I think you can make money in an honest, fair way that benefits people versus potentially putting people in investments which could bankrupt them or destroy them. And they should have at least on the phone said, by the way, you know that when you buy these shares of Dell Computer that I'm going to get a trip to Hawaii and my firm is actually the one who's selling those shares to you. Just in disclosure, so you know that, right? That would change the course of markets, in my opinion. Unfortunately, that's the way that it is. Anyway, I have to wrap up today. I can't be going too long. Let me do this one real quick. There you go. So Lori says, you said that you wouldn't put over $250,000 in any one bank. What about brokerages? Would you have over that amount in one brokerage to keep or to trade? So here's the deal. With cash deposits are FDIC protected up to $250,000. Brokerage accounts are FDIC SIPC protected up to $500,000. So $500K is where I would go to a limit with a brokerage account. How can they live with themselves? You know how he can live with themselves? With his with his Ferrari and all of his money, right? Money can change a lot of people. Some people get money and turn really greedy. Other people get money and stay the same or become better. But same story with insurance. A talk track from LB they gave me. Hi, my name is Merlin Rothfeld with LB. We talked to you about 6 months ago and told you that we wouldn't call unless we had something. Yeah. Gosh. Drives me nuts. Let's see. Last question, then I'm going to wrap things up here. Tom says, if Silicon Valley Bank had access to liquid credit equal to their deposits, they could have handled the run and sold securities in an orderly manner and paid back the creditor, right? Yes. What happened is panic started. So what happens, as you heard of Bill, like their portfolio was all long-term bond. That was a mistake. That was a huge mistake. And I agree with him. Stupidity. What at a minimum, Silicon Valley Bank should have had half their investments in long-term and half short. Because if you're all locked up in long-term securities, there's no way to unload those quickly. I mean, you can get out of the bonds, but you might have to take a loss. And depending on interest rates, you could totally get hosed, which is exactly what happened. So if they had short-term treasuries, let's say they were just in 6-month treasuries, this would not have happened. Because they wouldn't have held those treasuries that long and taken a big loss. They might have lost a little because of interest rate rises, but they wouldn't have gotten their clock cleaned. And because people started pulling money out, and then the rumor started, oh, there's not enough money there, then everybody who had over 250 was like, get my money out now, I want it. And that's where the problem started. Don't give into the panic and fear, right? If you are under 250 in cash, there's no fear. You don't need to run down to the bank and wait in line. Don't worry, you will get your money back. You'll be protected. Anyway. Merlin, do you still trade futures? I see you just talking about options and crypto. I do, but not as much. I really focus now more just on options on the indexes. I just had better success consistency with that. So, I have a futures account. I just don't really use it. Can you take a volunteer survey of the experienced traders here? If you day trade futures, like how many positions do you attempt in a day? What's your stop cut? You're going a little bit deeper there. It's kind of a tough one because you have a whole bunch of people answering all at once. How many positions do you attempt? I will typically tell you that when I was active with futures, 2 positions was kind of my max to juggle. Futures can move fairly quickly, and plus the leverage aspect, I didn't want to get things. I didn't want too much going on. Plus, I'm typically having some equity exposure, and now it seems like I'm doing a lot more options. So, let me see about getting a poll done for that one. It's a complicated one. TC, iBond feedback. So TC asked me about iBonds today as well. I thought you did. Yep, there it is. So here's your question from iBonds. What is the word on iBonds? How safe are they in today's turmoil? A lot of bad news pertaining to bonds. Could use your feedback here. iBonds are fine. You're not worried about iBonds. iBonds, the only real risk that you have there for iBonds is that the interest rates just really plummet from here and the yield starts to drop tremendously. It's still government backed, so you're still fine. It's very different than what you're seeing with treasuries. This is not your typical treasury product. It's adjusted for inflation. So the next adjustment, let's see, was October was the last one. So I think you're actually getting the next one here in, is it May? I think it's in May we get the next adjustment. And that's most likely going to drop down the yield on iBonds. So your only real risk here is that the yield is declining and you're going to get less interest payments on those iBonds, but it's still going to pay you fine. The reason that these firms got in trouble with bonds was the yields were so volatile and the yields ended up rising so significantly that the price of those bonds had declined significantly on the 10-year. And when the Silicon Valley Bank went to sell those, because they were forced to liquidate positions to cover their customers, they had to sell those at a significant loss and therefore lost a bunch of money. Yeah, that was May. Mike McMahon? I don't know. I was actually going to see if I could bring him on. It's Mike McMahon's birthday on Friday, so I thought maybe I'll try to bring him on. I'm 60. I've never met anyone who got money from the FDIC. Have any of you? Well, I've never been in a situation where the money that I had in a bank was unprotected. I've never lost any money in a bank. I've had them mess up my deposits occasionally. That's twice in my life that they messed up deposits, but other than that, I've never had an account that has FDIC worries, right? I've never had a bank shut down on me. Knock on wood, that might happen at some point in the future, but right now I've never had it happen. I don't think, has anybody here had it happen? Yes, with a glass of nice Irish whiskey. Let's see. What else? That's $500,000 per account in a brokerage, I believe. Correct. Right. So it's the same thing with FDIC. It's per account. So if you got $3 million, then open $500,000 brokerage accounts in 6 different brokers, and that way you're covered underneath the government guidelines. Now, if you got $50 million, you can open a lot of accounts. Anyway, let me wrap up here, guys. My voice is going out. I still have some prep work to do, and my poor dog is just dying to go out on a walk since it's been raining here nonstop since last night. Here's your economic calendar for tomorrow. Actually, hold on a second. Before I get to that, we do need to talk about what happened out there today because the numbers were rather interesting for today. So here is, okay, that's tomorrow. Let me go out to my Forex factory and pull up what happened out there today. Here you go. So we look at the numbers that came out today. Wow, I did not expect this at all. I actually thought we would see in line with expectations, shattered expectations. Here is the PPI number, which actually showed a contraction. From an inflation perspective, that's really, really interesting. You know, we did have it again a couple months ago, but that we so quickly turned and had an about face here. That's great. Now, CPI was not negative. And again, if PPI keeps dropping, then the theory is that should pass on to Consumer Price Index next month, which could put Consumer Price Index at the 570 mark, 560, somewhere in there, which would be really good for the Fed and their decision to keep raising rates. So that number was great. You had the Empire State Manufacturing Index is really bad, right? You've seen it. This below zero means contraction, and expectations are very negative for manufacturing in the New York area. That's not good. So you had one great piece with PPI, bad piece with Empire State Manufacturing Index, and then another bad piece with retail sales. We've had this negative 0.4. It was supposed to be negative 0.3, so not a huge miss, but still not that great. It really was not the greatest number out there for today's market. So those are your main pieces that I think were noteworthy for the U.S. markets. You also have the TIC long-term purchase number, which came out much worse than expected, but we'll shift focus there. So here's what's happening for tomorrow. We don't have the colossal announcements like we did today, but you do have unemployment claims, Philly Fed Manufacturing Index, building permits, housing starts, import prices. I mean, a lot. The bigger stuff is going to happen at 6:15 a.m. That's 15 minutes before the U.S. markets open, and that is supposed to be a 50 basis point increase in the Fed funds rate called the main refinance rate for the European Union. See if that one ticks up there and puts more pressure on the European Union. So we're not done with this week yet. We've got a couple days left. You've got Thursday and Friday, which of course we have triple witching options expiration. You've got all kinds of rate announcements and economic data. So it should be fun. I don't have any guests slated for tomorrow. The good news is I have a lot less on my plate. I'll be doing a crypto class in the morning from 10 to 11, and then I maybe have a little chance to rest and catch up because today has been a whirlwind. That said, thank you guys. I appreciate the patience out there. I know I'm messing up today, but I'm literally in la-la land, having just spoken straight for almost 8 hours. So now that my voice is crackling on me, I hope you guys have a fantastic remainder of your evening. There's no real earnings announcements that are noteworthy tomorrow. So email me at TraderMerlin@gmail.com if there's something you want covered on tomorrow's show. That said, have a fantastic trading day. I'll see you Thursday.